Did the markets even open today? Absolutely listless across Wall Street as we finish the first day of the week here, but we do have an action-packed week ahead. Not so much in terms of data, but certainly in terms of Fed watching. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we're going to do here is take a look at what the markets did last week by way of stage setting to see what might be coming up next, and then take a look at the risk from the event calendar immediately in front of us and try to get a sense for what all of it means going forward. Because we do have, against all odds, despite a relatively thin offering on that calendar, plenty of risk to contend with. So let's consider first how the markets did last week. We can see a modest increase for the S&P 500, a modest increase for the NASDAQ, things slowing down significantly from the prior week, just 0.4% added for the NASDAQ, 0.9% for the S&P. A kind of a mixed bag on yields. On the front end of the curve, things relatively steady. It looks like Fed policy expectations looking mostly anchored here. At the long end, slight uptick on yields, but not a whole lot to write home about, 0.9% gain. Crude oil continues to do its own thing, down 1.7% last week after a 5.1% drop. There's, of course, lots of back and forth here. We had a meeting between U.S. President Trump and Russian President Vladimir Putin in Alaska. Now the president is meeting, President Trump is meeting with the leaders of the European Union alongside Ukrainian President Volodymyr Zelensky. So we'll see how that goes. For its part, crude oil is basically pinned to the center line of the range that has basically contained all of what's going on, geopolitical crises in the Middle East and Russia inclusive, since basically mid-September of last year. That range roughly between about $74 a barrel and $54 a barrel on the WTI contract. We're pinned right there and we're not going very far. So despite these oscillations here, not a whole lot that's going on. Gold price is down a little bit last week, in by 3.1%. But again, that stuck in a range, and in fact has been in an increasingly narrow range since late April, once the dust settled on Liberation Day. So we're looking on a market here that wiggled a little bit, but ultimately isn't very much changed this way or that. Euro a little bit higher, yen a little bit higher last week, so very modest pullback in the US dollar. Bitcoin basically idle. So really all the action last week seems to happen here on the equities side and by slight extension in the bonds. And what's particularly interesting about this is it all basically happens on a single day. So consider, this is the S&P 500 here, the continuous contract for S&P 500 futures, and just do the count back here 5 days. Here's last week. Nothing happens Monday. We get a US CPI report that the markets get all kinds of jazzed up about. And then for 3 days, nothing. Standstill. As a matter of fact, the S&P 500 ends last week across these 3 days, this side. Across these 3 days, there is absolutely no movement. 0.05% is the net change across these days. So if not for this CPI report, the markets did nothing last week. Moreover, in the wake of this CPI report, they found no fuel for follow-on conviction. It's a similar story for the NASDAQ here. Here's the CPI report right there. And actually, in the NASDAQ's case, over the subsequent 3 days, it managed to inch down a little bit off 0.56%. So it moderated this rally a little bit, but again, no conviction. So what was it in that CPI report that was so eye-catching, and why did it fail to give the markets anything but a single day's worth of support? Well, we can see here that the inflation numbers came in refreshingly, quote unquote, normal, 2.7%. So inflation flat from one month to the next, from June to July. The core number ticked up from 2.9 to 3.1, a little bit of a tarnishing on the overall story, but the market seemed to be relatively okay with that. More importantly, the expectation here was for 2.8%, so ostensibly this came in a touch lighter than expected. And the markets took that to mean that the Fed is going to be ready to cut rates. Most inflation still stuck in services. The inflation from the goods side still relatively modest, though rising. And perhaps this is why we ended up without follow-on conviction. The markets loved what they saw at first glance. But then, of course, we see that a quarter of a percentage point almost was added from the goods side. And indeed, if we take a look at the change month on month in contribution to overall CPI, we can see that while most inflation, of course, remains on the services side, it's also stalling, and as of July, even inching down by a little bit. Whereas the thrust from the goods side for a second consecutive month looks relatively potent. In fact, if we disaggregate inflation here into core goods, core services, and shelter, the main components, we can see here that services inflation actually cooled from June into July, whereas goods inflation quickened. Moreover, the year-on-year pace of core goods inflation has now increased to the highest in 2 years. Whereas for the service side of the story, we certainly have been inching higher, but we're only the highest we've been since December of last year. So a much more modest sort of situation here. And of course, for shelter, the trend speaks for itself, even though in July, this marked a little bit of an uptick. So we can see here that goods-based inflation is inching its way into these numbers, giving us exactly the kind of thing that the Fed is concerned about. That is to say, tariffs being at the same time a pushback on growth and a push up on inflation, which of course complicates policymaking. The pushback on growth would demand rate cuts. The inflation would demand, at the very least, not cutting rates, if not raising them. And so the Fed continues to sit on its hands, to everybody's consternation. Now, we can see that in the wake of those CPI numbers, through these few days of digestion, we still are looking at the likelihood of a September rate cut as overwhelming by historical standards. Generally speaking, when you're meaningfully above 55, 60%, the Fed almost always, if not always, delivers on those expectations. The question is, how far away are you from, let's say, 55% on the eve of a meeting, or let's say a week before a meeting? We're a little bit further away from that here. The next Fed meeting is September 17th, so we're a month away here. So lots might still change, but this still looks fairly convincing at 83% and about 17% chance for a hold. What's eye-catching, of course, is that in the wake of CPI, we were looking at 94% chance of a cut. This, that is a hold, had a 0% chance. And there was about a 6% chance that we'd get a jumbo 50 basis point cut. Obviously, in the subsequent 3 days, 4 days, things have changed significantly and the markets have come off that dovish extreme. Part of that, surely, is a deeper thought about what we've just talked about, the appearance now, tepid though it is, of core goods inflation, a sign that the tariffs are making themselves known, starting to show up in the numbers. But where it really presented itself with much more conviction was the PPI report, the producer price index numbers that followed the CPI data. We can see here there is a dramatic month-on-month jump. In fact, the largest one since back here in 2022, which is, of course, the meat of the post-COVID inflation scare. And what we find when we disaggregate this a little bit, here is the jump for final demand, that is wholesale inflation for goods that are ready to be put on shelves, final wholesale, as it were. And here we have the biggest increase in the margins component for wholesalers. This services component, the trade services component, measures wholesalers' margins. And what we see is a massive expansion in their margins after a fairly soggy showing earlier. In fact, this was the largest one, again, since back here in early 2022. Even more eye-catching here, going earlier in the supply chain, was this jump in margins at the intermediate demand level. This is early in the supply chain, before you get closer to retail and closer to consumers. This is just after the goods that we're talking about and even inputs into final goods that haven't been finalized yet. This is as close as you can look, for the most part, to margins for wholesalers near where tariffs are assessed. This is the beginning of the US-based supply chain. And here you can see that earlier in the year, there was a move by wholesalers at this part of the supply chain to eat the inflation. So you see this massive deterioration in their margins here in shock of shocks, April. And you find that they're basically looking at the uncertainty around the tariffs and saying, look, we're not going to pass on these extra costs to wholesalers downwind, and certainly not to consumers, because we don't want to destroy demand. We don't want to increase prices and drive everybody home, because we don't know what this policy is going to do. We don't know exactly the scope of the issue. So we're going to eat it into margins. We're going to take on the burden of these extra costs, and we'll see what happens. Well, now it looks like we've seen what happens, because we can see that the costs are being passed on here. The margin expansion suggests that faced with higher costs, these wholesalers have started to pass them downwind. We see that here. And of course, that suggests that whatever we saw here is just the beginning. We are ostensibly just warming up there. And there's quite a bit more to come if this pass along is going to continue, which is perhaps why the markets looked at this and said, wait a minute, hang on. This is not necessarily everything there is to see. There is some degree of smoke and mirrors in this data still. And of course, the biggest issue here comes down to consumption. If in fact we've seen that so far things have been relatively well anchored and the economy has held up reasonably all right, and so perhaps it was tempting to say, well, these tariffs are not a big deal. It's difficult to make that case when you see that the costs of the tariffs were being insulated away from consumers. And even with that, as well as, of course, another barrier to inflation surging, this front running of the tariffs in the first quarter through the restocking of inventories, we still have the weakest consumption, the weakest contribution from consumption to overall GDP in the first 6 months of this year since the first 6 months of 2020, which was, of course, the COVID recession. Now, you can see here, this is contributions to GDP. Imports are subtracted from GDP. So when they grow, that is a negative contribution. And when they fall, it's a positive contribution. So you can see in the first quarter here, imports surged, which was a big change in GDP, where we had a significant pull down from essentially companies front running the tariffs to stock up inventories to then sell out of inventory and not out of post-tariff expensive goods. We also saw, and this has a breakdown of the investment component here into fixed investment and change in inventory. You can see that residential investment is essentially non-existent on here. Non-residential investment is a sliver. The biggest surge here for the overall investment component is this change in inventories. It's all of these it's all these imports going into warehouses. Now look at what happened in the second quarter. You can see that the defense mechanism here against tariff costs is unraveling. Imports are a positive contribution, which is to say that they're falling. Inventories are a negative contribution, which is to say they are being depleted. So the front running of the tariffs is spent. It's over. And so instead, what you're looking at is wholesalers passing on inflation costs and back inventory of goods at a pre-tariff structure for its prices. That's dwindling. And so, not surprisingly, there is the possibility here that higher inflation will crimp consumption, and the starting point before that bites is already the weakest consumption since the COVID recession. So not surprisingly, the markets want these rate cuts very much. The threat here is acute. Europe is still at standstill. China is still at standstill. If the US falters, the global economy is without its only operating engine. So, when we look at then the consumer confidence numbers that we end up seeing on Friday, it is no surprise that consumers were savvy. They saw the inflation reappearing. They saw the pass-through occurring. And so sentiment deteriorates. In particular, the assessment of the current situation sees a meaningful decline, overall sentiment down, and that's happening against the backdrop of inflation expectations rebounding. We're back to 4.9% on the one-year inflation outlook. And it is with that in mind that this week becomes all about whether the Fed is actually going to deliver on these rate cuts. Now, as it stands, the markets and the Fed are basically of one mind for the outlook on this year. The markets have 47 basis points. When the Fed issued their last projection in June, that's what they had. The current median is 4.4, down to 3.9 is 50 basis points. The disparity occurs for next year, where the markets have 70 basis points. That's most of the way to 3 rate cuts, whereas the Fed, from 3.9 to 3.6, has a single 25 basis point cut. And this is where things get interesting. The first major touch point this week, minutes from July's FOMC meeting. In that meeting, we had something of a moderating flavor to what the Fed was saying. It took back this idea that uncertainty about the economic outlook has diminished. It thought maybe it did in June, and then in July it promptly reassessed. We still see a relatively steady statement thereafter, although we have here the indication that growth of economic activity has moderated in the first half of the year. We get that sense. That would be that weak consumption that we just looked at. But interestingly, we get two dissents at this meeting. Governors Chris Waller and Michelle Bowman vote against the consensus. The consensus decides to keep rates unchanged. Bowman and Waller decide that they're going to vote for a cut. What's interesting in this context, of course, is just how telltale that is of a broader shift in the thinking on the FOMC committee. And so minutes from that July meeting, due on Wednesday this week, should be very interesting to see because, needless to say, in the wake of this stage setting, then followed by CPI, the markets talked themselves into believing that the Fed is increasingly on autopilot. If that is not the case, if for Waller and Bowman this was not a massive head change, but instead just a thinking about sequencing and the idea that it takes between 12 to 18 months for a single rate cut to be fully absorbed into the economy, so maybe it doesn't make sense to be overly cute about it, this meeting or that, but to just get on with what will be needed in the economy a year hence, year and a half hence. If it seems like there isn't a broadening dovish consensus to be extrapolated from these dissents, that probably tells the market that the Fed is not nearly as expansive in its thinking as what is currently priced in. Again, the markets are valuing securities from the perspective that there is 117 basis points in rate cuts on the menu. And for the Fed, there's only 75. And then, of course, there is the Jackson Hole Symposium. This is the annual central bank conference that the Fed holds in Jackson Hole, Wyoming. As ever, the main event for the symposium will be Friday's Fed Chair Powell speech. That's a kind of annual lens setting exercise where essentially Powell tells investors, or whoever the Fed chair is tells investors, how to think about valuing the trajectory for policy a year forward. It basically establishes for the markets the sort of academic and tactical lens through which the Fed is looking for the year ahead, so that Fed watchers, markets, of course, front and center, can take in information, incoming economic data, incoming headlines, filter them through what they then believe the Fed's thinking is, the sort of overall structure of how the Fed considers the way forward, and see if they can then come up with expectations that approximate what the Fed might actually do. If that stage-setting exercise does not give us the dovish conviction that investors want, if it does not set us up to come in September, not just with a rate cut, which again is widely expected despite some diluting of the chances here, and if what comes of it, that September meeting, is not a meaningful revision of this into a more dovish direction, well, then perhaps the markets are not going to have the confidence that they've been having about the idea that the Fed is coming to their rescue and will avert an economic downturn before it really gets to be a dangerous sort of thing. And if that's the case, well, then the markets perhaps have some room for a pullback from these levels, because then perhaps we've arrived at the idea that with the U.S. clearly cooling, as even the Fed has recognized, with consumption, which is 68% of overall GDP, now contributing a pittance, and with the inflation dynamics here, again, as surmised by this consumer confidence data, and as telegraphed in this PPI data, as well as now this slight angling beginning to seep into CPI, if that's going to give us a consumer that's more reluctant, if consumption then continues to weaken into the third and fourth quarters, even as the Fed is worried about the inflation piece and holding back from the kind of stimulus that would actually push back on these dynamics in a timely fashion, well, then perhaps the markets will reason that assets are just too expensive for a rosy, soft landing kind of a view. And where the likelier scenario is that the Fed is going to have to do some catch-up cutting because it will have allowed the economy to weaken more than is optimal. And of course, the tricky thing with recessions is they are non-linear. So once you've missed the opportunity, there's no telling what might end up at the bottom of the pool once you start to drain it. If a recession, even a very mild one, were to strike, all manner of knock-on effects become possible. So when we look at the way that the markets are likely to treat this week, and in the way that they've approached last week, when there is something dovish, or could be painted as dovish, the markets seem to be in generally good spirits. Absent immediate fodder fueling that idea, they are at best listless. And if the commentary this week from the FOMC minutes and from Powell ends up looking less than the perfect dovish world that the markets would love to see, well, then the markets, at least for the equity space, appear to be somewhat soggy in their positioning and might end up slipping. That, of course, is likely to have knock-on effects on bonds and the dollar, where haven demand might prevail. And we'll see what it does for crude oil and gold. And if it manages to engender some directional conviction there, finally. With that, we have macro money for today. We are, of course, here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go there from. I'm likewise on with Chris for Futures Power Hour Mondays and Fridays, on with Chris and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.